Morgan's Chief Economist Michael Knox, thanks for your time. Michael, it's been a massive week for investors this week on global markets and domestically. We've seen Australia and the US lose 10 to 12% each. They're bouncing now, but China is still weak. It's given up a bit more. Should investors feel fearful at the moment, or is this an opportunity?
I don't think this has much to do with China. I think we have a correction that's made in the USA. It started, or has started, for one reason, and will finish for a second reason. The reason it started is because operating earnings per share growth for the year to June were disappointing. By our measure, which is, like I say, operating earnings per share, it fell by 10% for the year to June. And there was significantly underperformance of big companies, particularly oil companies, in their earnings reporting for the S&P 500. So that knocks down our fair value for the S&P 500 at the end of the year to about 1840, thereabouts, and the market was trading in a moderately overvalued area, about 2100. So that's what's generated the initial shock. Now, our view of the US economy is actually pretty good. We think that the US economy was weak in the first half of the year, a bit because of falling oil prices and a low level of investment, drilling investment in new oil fields, that kind of stuff by oil companies. But the US economy is much stronger in the second half of the year because we've got housing investment recovering, but we've also got business investment, particularly investment in equipment and software, technology investment accelerating, and we think that's going to accelerate into next year. So we think that for the full year this year, the US economy is going to grow by about 2.2%, and for the full year next year, it's going to accelerate to about 2.8%. Now, the problem with that is that the Federal Reserve is meeting 3 times between now and the end of the year. And the Federal Reserve have already said that they're very likely to start putting up interest rates, start putting up the Fed funds rate. They haven't put up the Fed funds rate now for 8 years. And when they do it the first time, we think there'll be another shock to the market. So the market is recovering from this initial sell-off caused by lower earnings. And we think that when the Fed decides, either in its September meeting or its October meeting or its December meeting, but certainly one of those 3 decides to hike rates, they'll generate a second sell-off.
Sure.
And that will generate the continuation of this correction and bring this correction to an end. When we look at next year, that stronger growth in the US economy is going to generate better earnings and a better outlook for the US stock market. But that's next year. We've still got the correction to get through.
Yep. So you're quite clear on a cautious approach into that first rise in the Fed funds rate. And you did touch on this problem, this volatility being made in the USA. Can you put us at ease on your thoughts on China and just how real or not the risks are there in the next 6 months?
China is much misunderstood. What's happening is that the Chinese government is following a policy of moving from a manufacturing-based economy to one in which there's far more services and much more consumer demand within their own economy. Their surplus, their current account surplus, is only around about 2% of GDP. That's smaller than countries like Germany, for example, which have current account surpluses of 6% of GDP. So that means that already 98% of their products are all sold domestically. That's what that means. And they're trying to increase the proportion of their products which are sold domestically. So as they move from a manufacturing economy to a services economy, we can see that in measures like the manufacturing PMI, which has been drifting down all year. And the market, I think, took shock at that last week. It shouldn't have, because it was just a continuation of government policy. Because at the same time as that indicator's going down, the PMI, the Purchasing Managers Index on non-manufacturing, has been going up for the previous 3 months, and demonstrating that the government policy of moving from manufacturing to services with the economy is actually working. And so we think growth this year in the Chinese economy will be about 6.8. It'll be 6.3 next year, but that's a gradual slowing as the proportion of the economy changes.
Sure. So reassurance on China and caution into the Fed funds rate rises late this year. Michael, thanks for your time.
Thank you.